New all-time highs in the S&P 500 and Nasdaq composite indices, let alone the policies of new President Donald Trump, mean that America's stock markets continue to dominate the headlines. But in total return terms in sterling, the best performing region of 2017 to date, and for the past 12 months for that matter, is Asia Pacific ex-Japan. As we can see here, by contrast, the US ranks just 7th out of the 8 major regional options in the year so far. The UK comes 4th. So in this latest edition of Fundamentals, I'm going to look at one passive route to gain access to this year's top regional performer, namely iShares Core MSCI Pacific ex-Japan ETF. This is an exchange-traded fund, or an ETF. It's designed to track the performance of the underlying assets and then deliver that performance minus any running costs. In this case, the ETF is tracking an index that features around 150 large and mid-sized companies from 4 of Asia's 5 biggest markets, namely Australia, Hong Kong, Singapore, New Zealand. The nation that's excluded, as the instrument's name suggests, is Japan. China doesn't feature either, not least because its domestically listed A shares do not yet feature in MSCI benchmarks. iShares Core MSCI Pacific ex-Japan uses physical or direct replication to generate performance, so it owns the underlying securities. The top 5 holdings as I sit here are Commonwealth Bank of Australia, Westpac Banking, Hong Kong-based insurer AIA, ANZ Banking and National Australia Bank. Mining giant BHP Billiton is 6th on the list, by the way, via its quotation in Sydney. By country, Australia is just under 60% of the assets, Hong Kong around 28%, Singapore is 10%, New Zealand the rest. By sector, as you've already probably guessed, financials dominate at 40% of the assets, with real estate next up at around 15%, followed by industrials and mining at 8 to 10% each. Tech, energy and telecom are only lightly represented at just over 7% of the portfolio. The tracker comes with an ongoing charge figure of just 0.2% a year, so it's very cost effective. According to data from Morningstar, it's actually the cheapest ETF in its category. The iShares product is around £760 million in assets under administration, so it should be pretty liquid, at least under normal market conditions. This particular instrument comes with accumulation units, so any advisor or client buying will have dividend payments automatically reinvested for them. The tracker's over 7 years old and comes with a 3-star ranking from Morningstar for those who place importance in such things. So, those are the mechanics. The next question is, why would advisors and clients consider this ETF for their portfolio today? And I think there are 3 factors to consider. First, anyone who buys into the global reflation or Trumpflation trade in the view that global growth and inflation are about to accelerate will be looking for indices with hefty weightings towards banks, financials and real estate plays. That's because these are the sectors that do well in such an environment, at least if history's any guide. And, as we can see here, the ETF has done well over the past year. Second, Singapore is also seen as a good play on global trade and global growth, with banks, real estate and industrials over half of the local Straits Times' index's market cap. Finally, Australia is heavy on mining and resources stocks, and is therefore seen as a way to access the China growth theme. With the 19th Communist Party Congress taking place this autumn, it seems very likely that the authorities will do their best to make sure that China hits its 6 to 7% GDP growth target this year. That could, in theory, boost raw materials demand. Now, this isn't to say that this ETF will necessarily suit everyone, as there are 3 clear risks. First, some analysts are expressing concerns that the Aussie housing market is getting terribly overcooked. Now, that may not make it too different from the UK, Sweden or Canada, but a downturn could hit the Australian banks, which feature so prominently in this ETF's top 10 holdings list. Second, banks and financials always seem to be in someone's sights. This month's budget in Australia featured a new 0.015% tax on the balance sheet liabilities of the big 5 Aussie banks, as Treasurer Scott Morrison battled to balance Canberra's books and the banks went down as a result. And finally, having primed its economy with fiscal and monetary stimulus last year, China is currently tightening policy this year, so its own property market and economy don't boil over. That's currently hitting metal and raw materials prices, and mining stocks are sliding in sympathy. Any big slowdown in China could therefore be a problem for some of the underlying stocks tracked by this particular ETF. In summary, advisors and clients must do their research to make sure that this particular ETF, iShares Core MSCI Pacific ex Japan ultimately fits with their overall strategy, target returns, time horizon and appetite for risk before they put any capital to work. Thank you for watching, and I look forward to seeing you next time.